Hi folks, it's Rob Flux here from Property Developer Network, coming to you for another Sunday session. Today's Sunday session is going to be a little bit controversial. Going to be talking about the ability for banks to actually access your hard-earned cash. So this session is entitled Hands Off My Money. Now it's following on from a series of events that I've been doing over the last 4 to 6 weeks in talking about our economy, where it's going, and I guess some of the issues and challenges on the road that lays ahead with our economy. And that's been triggered by a number of other elements that have happened in the last couple of weeks. Now, as with all of these sessions, I want to just declare that a legal disclaimer. I don't have an AFSL license. What I'm giving you here is educational in nature and should not be deemed to be specific advice for yourself in any way, shape or form. But otherwise, it's just really my opinion. So why am I talking about this topic? Well, it actually came about because there was an event that happened a couple of weeks ago with Members Equity Bank or Me Bank. And they, at the very last minute, changed their redraw rules without warning to their customers, where customers had actually paid down a significant amount of additional capital into their loans. And Members Equity Bank then used those facilities and effectively wrote them off the loan, effectively grabbing that cash, writing down the loan, and withdrawing their ability or removing their ability to actually redraw those, even though it was technically a redraw account. So this is a story that was, I guess, put in the ABC News, but there are a number of other stories that sat in and around it. Where it becomes really interesting is that they moved that facility very, very quickly without notice. They dated the notification, I guess, on a particular day. Then they executed it. And then by the time that notification actually arrived in the mail, it was already too late. It actually had already gone already gone in force. Now, it actually affected about 20,000 clients. So this was news.com.au. So about 20,000 clients had their loans drawn down. And the excuse given by Members Equity Bank was that they believed that because of the fact that the coronavirus is causing a number of things with our economy, that they thought that those borrowers would struggle to actually service those loans, which is really a telling sign to say that the banks are getting a little bit nervous about this economic climate that we're coming into. Now, there was a lot of conjecture at the time to say whether or not this was actually the fact that Members Equity Bank was actually struggling with liquidity. So ME Bank is actually owned by a number of industry super funds. And because of the fact that the industry super funds had the $10,000 ability to withdraw, there was a lot of speculation that that was actually, I guess, being impacted by the ME Bank. Now, ME Bank have said that that wasn't the case, that it wasn't really a serviceability issue, and that it was really just a poor lapse of judgment. And to that effect, they've issued a withdrawal of that, and they've actually, on the 8th of May, they reversed their original decision. This is an apology letter publicly on their website saying, sorry guys, we stuffed up here. We shouldn't have done that. Very poorly communicated. We humbly apologize. What's really, really interesting, though, is in the apology itself, there's actually a little bit of a get out of jail free card, basically saying, well, we're only going to give it back to you if you actually ask us to. And so they're really, really wanting to keep those cash, and effectively write off that liability within the bank. So you have to physically complain in some way, shape or form by either giving them a phone call or requesting it online. Otherwise, that decision won't actually be reversed, even though they have publicly apologized. So really, really interesting. The thing is, though, that the ME Bank aren't the only ones at the moment who are doing a number of changes that are a little bit under the covers, let's just say. So here's another story from ABC where Commonwealth Bank have impacted 750,000 customers by just dropping their automatic repayment to the very bare minimum. Again, they're trying to say that this is so that they can ensure that they can actually service their loans, and customers have to actually opt out of this. The reality of this, though, is that what it really does is means it draws out the loan over a much longer period of time, meaning that the banks can actually get more money, and improves the, I guess, the profitability of the banks, who are at this moment in time all reporting some fairly significant impacts to their profitability in the coming 12 to 24 months. Most of them are reporting significant drops in profit, and some of them actually reporting significant losses. So why are they doing that? Well, let's have a look at what's happening in and around the economy. It might give us a little bit of an insight as to what's actually happening. Now, I've been covering this for some time, so for those of you who've been following me for a while, none of this is actually new. As we know, interest rates are at a record low. So because of that, the RBA has no wiggle room to actually stimulate the economy. That basically, once you get to zero interest rates, you can't go any lower. Now, you actually can go lower. You can go into negative interest rate territory, and the government actually presented a policy on a cash ban prior to COVID-19 coming into existence that didn't actually get up, because they could see that irrespective of COVID being here, that the Australian economy was actually struggling to get momentum. And so it was thought that if they could enable negative interest rates, that it would, I guess, kickstart our economy. Now, that, as I said, that policy didn't actually get up, but it gives you an insight into where the government thought our economy was actually sitting at that point in time. And then COVID's come and kind of pushed it off the edge. Now, on top of interest rates being at record lows, unemployments are at record high. So the ABS is projected to, I guess, come out with news this week on the 14th. So we're only about 4 days away from them giving us last month's stats, and they're projected to come out with a 10% unemployment rate. Now, they don't actually report on underemployment, remembering that they've got a whole bunch of stimulus in place with the JobKeeper to keep underemployment still on the table. So if that underemployment wasn't there, that unemployment rate would be much, much higher. And so people like Roy Morgan, who are talking about that, they're talking about anywhere between 16 and 20% of under and unemployed on the market, which is a telling sign for, I guess, the amount of money that we've actually got in our economy to actually spend. With those limited incomes means that there's going to be limited spending in our economy. If there's limited spending in our economy, that means that there's minimum businesses actually earning an income, which means that those businesses may have to lay off staff, which means that then there's even less money in our economy, which means that less people are spending, which then becomes this self-fulfilling circle. And so it will actually slow us down. Question is, how much? So with that in mind, I guess there's a couple of challenges we've got. We're not the only ones impacted here. The world economy is actually impacted, including our two of our biggest trading partners. So the first one is China. The second one's actually Japan, and USA is third. But USA and Japan, I guess, are massively impacted by this coronavirus impact. Now, USA is certainly in a lot of pain. And there's a lot of speculation as to the accuracy of the figures coming out of China as to whether or not what is there is actually, what they're reporting is actually real or not. So we really don't know what the implications are from a global perspective with other economies. And remember that other economies spend money with us and we spend money with other economies. So if everybody is impacted by unemployment rates, and USA's unemployment rate is just through the roof at the moment, then that's less money in the global economy, which means less people wanting to buy our resources and less people wanting to come in for international travel and holidays and all that sort of stuff. So it means that there's a great deal of potential that the world's going to start to come to a little bit of a grinding halt. I say potential, it's all speculative. What we're really doing is just trying to report on the facts as we see them. And the Australian government is injecting billions of dollars into our economy to stimulate the economy. So the JobKeeper and the Job Seeker have all been, I guess, put in to try and stimulate our economy and keep us afloat. But don't forget that we're going to be running out of that soon. So that was only projected for 6 months. We're about 2 months or so into that. We don't know what the follow-up to that is, if anything. I'm going to anticipate that there will certainly be more stimulus package coming, but the government is currently just concentrating on how do we get us back into the workforce at this moment in time before they worry about what their stimulus needs to be, because they don't know whether or not the workforce is going to kick-start back into gear. So we have to be really careful as to, I'm fairly confident that there will be more stimulus, but just don't know how much or for how long it's going to go for or things like that. But effectively, without that stimulus, without that money being injected into our economy, we're in a world of pain at this moment in time. So the obvious question is, will there be a recession? Now, I've commented on this one many, many times, but in the past in a lot greater detail. So let's just go through it as a little bit of an overview here. So let's have a look at the symptoms of a recession. So firstly, the technical definition is 2 negative GDP quarters in a row. Now, Q3 is already a negative. So that's a given. We're in the middle of Q4 right now. And as we are still technically in lockdown, whilst they're still slowly letting us out, they're not actually going to release us completely out of lockdown until the end of Q4. So the likelihood of us having a negative GDP in Q4, I'm going to say is extremely high. So from a technical perspective, I say, do we trigger a recession? Highly likely, yes. It'll be very tricky for them to not. The question is whether or not that's something that is just a technical recession or whether or not it actually has a massive impact on us. So let's have a look at some of the other symptoms. So the stock market and property markets lose a lot of value. Now, the stock market has dropped a lot of value and has now stabilized, but at the moment it looks like it's testing the rebound because it's not coming back. It's testing to see whether or not it wants to drop off the cliff again, but we don't know if it's going to go up or if it's going down. What it's really doing is kind of sitting there at the moment going, well, let us out and let's see what happens. So the market is having a little bit of an each way bet. Now, the property market has slowed down massively. So the number of listings has slowed down, the number of inquiries has slowed down, the number of buyers in the market has slowed down, and there are absolutely bargains to be had at the moment. Now, the challenge will be, and I'm saying here that it's actually on the brink, the challenge will be when the job keeper, when that stimulus drops off and people can no longer actually pay their bills, and when the current moratorium on not paying loans expires, at that point in time, I think there's a high probability that our property market will actually start to drop. So we're talking, I'm going to say 2 to 3 months from now. Right now, property prices are stable with the occasional bargain, but I think that I think it's inevitable that there will be some people that need to sell, and they will be needing to sell in a panic. The other symptom is unemployment rises, and as we know, we're already at record unemployment rates. So for all intensive purposes, will there be a recession? My lay opinion is the answer will be yes. The question is really, is it just a technical recession, or is it going to be something that is a little bit more widely lasting? Remembering that our economy is also stimulated by, I guess, international trade as well. And so if the international is struggling, I think we're going to be struggling quite significantly. So the cause of that, our debt levels rise too high and our repayment cycle is underway, meaning that our spending actually starts to run out. So the debts that we have accumulated in the past, we are now actually starting to have to pay back, because whenever you get credit, you're effectively spending future income. And so at some point you have to actually pay that future income back. And so we're currently, when a recession happens, that's really what we're doing is actually starting to pay that debt back over and above just spending for the sake of stimulating the economy. Now, all of the indications were that we're actually close to this prior to COVID-19. And so COVID-19 has just really tipped us over the edge in actually trying to trigger that. So I'm not blaming COVID. I'm just saying we're a victim of circumstance at this point in time. Government was trying to do what it could to actually ease us into a situation where this didn't get triggered, but COVID has come along and perfect storm at exactly the wrong time. So the remedy, typically, it's to lower the interest rates. But as we said, we're already at record lows. So what can they actually do here? And then with the lower interest rates, that normally stimulates more lending in the economy. The problem is, how do banks lend more money when we've got such a high unemployment rate? And with such a high unemployment rate, and also income from property values and that sort of thing being, I guess, those rental returns, now the tenants aren't even necessarily guaranteed to be paying rent, and they've got a moratorium to say, well, they can't get evicted. So banks are getting very, very conservative with their lending, which means that no matter how low the interest rates actually go, it is unlikely that we're going to trigger a lot of spending very, very quickly, because we can't borrow because the banks are just tightening up their lending conditions so hard. So the only really alternative is the government has to print money, right? So they've already stimulated the economy by, I guess, with the current round of stimulus packages. But what happens if at the end of this 6 months, what happens if we get a second wave? Or what happens if, I guess, when the 6 months runs out, has the government got enough money to stimulate the economy more by just pumping more things, so more infrastructure projects and things like that? It's really hard to tell at this point in time. And so the hypothesis is that if they can't kickstart us, then we're going to be into a very long recession, a long protracted recession. And if that happens, then I guess the extreme case of that is a thing called deleveraging. Now, I actually spoke about deleveraging on one of my previous things, so I'm not going to go into it today. But effectively, it gets to the point where the valuations in the share market, the valuations in the property market, and that sort of thing get to a point where that's where the security is actually held on all the bank loans. And if the security drops in value, then the security becomes less valuable than the actual loan itself, which means that the bank starts to go upside down. And hence, I guess the reason for this particular topic today, to say, well, let's just be a devil's advocate here, and let's just say that we do get into a situation where we, and I'm not for a moment saying that we are here, folks, so please be calm here. But what I'm just saying is, let's just stress test this and see, well, what would happen if this was the case? What are the sorts of things that we need to be considering? What are the sorts of things that we need to be prepared for? And what are the implications that may actually happen to us? So first question is, given that Members Equity Bank have actually gone and grabbed some money out of redraw facilities at the moment, the obvious questions is, if we have a recession, are our deposit funds safe? Now, on the surface of it, we would believe that that is the case, okay? Because there's a thing called the Financial Claims Scheme, the FCS, which is effectively a deposit guarantee. Now, the deposit guarantee comes into play for, protects us for $250,000 per account holder per ADI, okay? Now, an ADI is an approved deposit institution. So I'm going to be clear on those words. It's per account holder, per ADI, and that will start to play out in a couple of secs when I express that a little bit further. But what most of us don't actually realize is this deposit guarantee is not actually permanently in place. Actually, it has to be activated. So APRA, I guess as the Australian Prudential Regulatory Authority, need to actually go, okay, we're going to lock in this guarantee. And until they lock it in, then the guarantee doesn't actually exist. And so it's one of those things where we've got this perception that we're protected, but maybe we're not. Now, the logic behind it is that APRA, being the regulatory authority, are always reviewing the status of the banks, where they're at financially, all those sorts of things. And APRA can trigger this early if they see that there are times of trouble. So that's the theory behind it. Now, whether that plays out or not, let's just see how we go on this conversation, and let you be the judge of that, shall we? Now, as I said, per account holder, per ADI. So let's look at that in a little bit more detail. So what is an account holder? So an individual, a body corporate, a partnership, trustees, trusts, all those sorts of things, okay? So that's an account holder. Now, it doesn't really mention what happens if it's a joint account. So that's kind of silent. That's something to be mindful of. It's going to be inferred that it's an individual, but that not accumulative. So if there are two individuals as a joint account, I don't think it's actually going to be accumulative. It could actually be exempt, but it's not actually declared. So let's have a look at what accounts are protected. So this is the list of the accounts: savings accounts, call accounts, term deposits, number of ones going all the way down. And one I want to draw particular attention to is this mortgage offset account, okay, whether it's partial or impartial. And I want to draw even further attention to the fact that it has to be a separate deposit account. So it cannot be, as in the case of members' equity, a redraw facility. So redraw is where you actually pay down the loan into the same account, which means that it's not necessarily protected, and we'll play that out in a sec. But if it's in a separate account into a deposit account as a mortgage offset, then it would be protected. Interesting. Let's have a look at what accounts are not protected. Well, here it is here, credit balances. So a credit balance on a credit card or other loans. So that means if you are in credit on your loan, i.e. if you are have a redraw facility and you have paid off a little bit more than you were obligated to pay off, so you paid some extra into the loan, that is not protected. So really interesting that what members' equity did was actually something that would not have been protected if APRA needed to activate this scheme. Now, interesting in how that actually plays out, because it then says, well, maybe we shouldn't actually be using redraw facilities. Maybe we should actually look at other ways of doing that. So I'm going to go into how that works in a sec. Now, let's have a look at which ADI are you with. So an approved deposit institution. So I'm going to go, so this is all from the APRA website. These are just extracts directly off their page, folks. So what is protected is each licensed authorized deposit taking institution, right? So an ADI. So an individual account in an individual ADI. Now, why that's important, they actually state it directly on their page. Some ADIs operate multiple banking businesses under the one banking licenses, but with different trading names. And they give some examples. Bank West is part of Commonwealth Bank. St. George is part of Westpac, which means that if you're actually part of, let's just say St. George, then you're actually operating under the Westpac license. So if you happen to have money in St. George and Westpac, what they're saying is, well, we're actually going to combine those two together and deem it as one ADI, meaning that funds that you have in two banks are actually accumulated and only one lot of 250,000 is actually protected. They go on to then explicitly say a depositor might think that they have accounts with two different ADIs when both accounts are actually under the same banking license. They actually call it out very clearly, very plainly up front, right in front of your face. So they then give you a case study to go through. So let's go through this example. So Jane has two bank accounts in her own name. One bank account with Bank A has a deposit of $200,000. Another account with Bank Z, which also has a balance of $200,000. Now, Bank A is licensed by APRA under the name Bank A. Bank A also operates a banking license under its license, which trades under the name of Bank Z. This means that both of Jane's accounts are actually held under one banking license. So if Bank A fails, and if the government activates the FCS, then only 250,000 of Jane's 400,000 would actually be covered. They've called it out plain as day. It's there right in front of you, folks. This is because the 250,000 FCS limit applies to the banking license. Really clear. So it gives you some warnings to say, I need to not only potentially break up my money across banks, but I also need to be cognizant of which banks own which other banks. Now, they're called the Big Four for a reason, folks. It's not just because they have four names that they actually trade under. They actually trade under a bucket load of other names that you may not be actually aware of. So you need to go and start doing some deep diving to say, which bank am I actually with, and which banking license does that actually come under? So how is the financial claims scheme activated? So the FCS can only be activated by the Australian government in the unlikely event that a bank, building society, credit union, or general insurer fails, including where it cannot meet its financial obligations. So I want to be very clear that APRA can only trigger it once the bank has failed. So therefore, I guess there's a little bit of fluidity to say, well, if the bank hasn't failed, then the bank actually has some ability to potentially manipulate your money before it's failed and maybe get its hands on it beforehand. So, and I'm going to flesh that out a little bit further just as we go. Okay, so any amounts paid under the FCS will actually be recovered through liquidation of the asset or liquidation of the bank by way of a priority claim. Okay, so let's have a look at what that liquidation process would actually be. So, and what it says here, proceeds from the sale of the failed ADI would be distributed, with certain exceptions, in the following order. So if you had more than 250,000, you would actually be third in line. Okay, so APRA needs to recover the guaranteed money first and any incurred costs, and then anything above that 250,000 protection is third in line, which really is basically saying that if you have more than $250,000 in a particular banking institution or family of banking institutions, and if that banking institution actually fails, you need to wait for APRA to trigger this insurance scheme, and if they trigger it, then the ability for you to get more than that 250 is pretty far down the line, if and only if they manage to sell the assets. Remembering, selling the assets of a failed company, maybe they won't get the amount of money that they would like to for the asset, for example. So some recommended best practices in order to protect your funds in the unlikely event that this would happen. And I want to stress, in the unlikely event that this might actually happen. So do not put surplus funds into a redraw facility, okay? Because banks can, I guess, reduce the loan limit or redraw rules at any point in time. The example being Members Equity Bank, exactly what they actually did, okay? So, and at that point in time, you're not actually protected. The only reason ME Bank reversed their policy was because they had an uproar from their clients and they made a giant hullabaloo, okay? And it was I guess the power of the people that actually reversed that, not anything else. The alternative would be, if you have extra funds, the alternative would be to put the funds into a mortgage offset that is set up as a separate account. So if it's set up as a separate account as a mortgage offset, then it would effectively pay down the loan or just be deemed to have reduced your interest on the loan by the exact same amount as a redraw would have. But because it's in a separate account, that means it is covered by the FCS guarantee. So I guess that's the important distinction on that one, folks. Then, do not have more than 250,000 savings in any single bank, irrespective of the account type. It's the accumulation of all your funds across all of your accounts within the one bank, and that one bank's license, which means that some smaller banks and their subsidiaries actually operate under a single license. So if you happen to be in any of the Westpac family of banks, so it could be St. George, it could be Rams, it could be, I guess, Westpac themselves. But if you're in any of those subsidiaries as well as the primary, it all gets accumulated up and you only get one protection of 250K. So just beware of doing that. So make sure that you're distributing your funds across multiple. And that's kind of how you protect your bank deposits, assuming that the bank has actually failed and assuming that the FCS actually gets triggered. Now, at this point, folks, I'm going to go into some really, really controversial areas. Now, let me take a sip before I do this. Where I'm going to go here is to say, well, until we actually get to the point where it's failed, then you've got a couple of circumstances where the banks may just change the rules on you based on their terms and conditions. And I'm going to go into that in a couple of secs as to whether or not that's actually possible, which means that if they're still financially viable, then then the FCS guarantee can't actually be triggered. So could they actually claw that money at an early stage? Maybe, maybe not. Let's have a look at that. But if we start to go down this area, folks, we're starting to get into conspiracy theory territory. Okay, so I'm going to, great big warning, conspiracy theory ahead. So for those of you who are conspiracy theorists out there, now is the time to put on your tinfoil hats and let's go down the rabbit hole and see what the conspiracy theories believe. Now, I want to be very clear, folks, that this is not necessarily my point of view. This is the findings that I have found and what others are actually reporting out there as to what conjecture as to whether or not, I guess, these things actually exist. And that will make sense in a couple of secs. I'll give you my opinion at the end of this, but let's just go through what others are reporting at this point in time and noting it's conspiracy theory, folks, not necessarily true. So let's assume when we go down this rabbit hole that the bank truly is in trouble, then there's a thing called a bailout and a thing called a bail-in. And they're two different approaches that pretty much solve the same problem. So it really is trying to prevent the collapse of the bank by recapitalizing the bank to the point where it actually becomes a viable going concern again. Okay, so whether it's bailed out or bailed in, the primary difference is really who bears the financial burden of actually rescuing the bank. So let's have a look at the pseudo definitions, and I found many definitions. So this is kind of a hybrid definition that I came across. So a bailout occurs when outside investors, typically the government, rescue the bank by injecting money to help make debt payments. And because it's usually the government, that means that the taxpayers prop up the bank. A bail-in, on the other hand, is where the bank actually restructures or cancels the liabilities by writing down its bail-inable debt and converting it into equity within the bank, which means that the deposit holders prop up the bank. It effectively allows the bank to grab any deposits that are sitting there because they are deemed to be unsecured loans and convert that money into shares within the bank. So it takes the cash and says, well, that's now our cash and we're giving you shares. That's a bail-in. So the difference here, if we have a look at the difference, so the bailout helps creditors, the bailout helps to keep creditors from losses, while a bail-in mandates that creditors take the loss. So the creditors being unsecured deposits. Now a deposit is effectively an unsecured loan into the bank. Now, why do I mention these two different approaches? Well, what's really interesting is that bail-in history has we've actually had bail-ins within Australia, believe it or not, going all the way back to 1892, 1893 during the Great Depression. Victorian government brought it in for approximately 12 months and a number of banks actually took that up at the time. So, you know, several hundred years ago, but we actually have a history of that here within Australia. Now, most of those banks were able to trade out of that, although one bank in particular took nearly 25 years to pay back those equities. But there are other banks that didn't actually make it through that process. And there's a really interesting thesis that if you have nothing better to do, go and do a Google for a gentleman by the name of Dr. Chris Berge, B-U-R-G-E. He did a PhD thesis back in 2016 that actually went through some of the history of some of this and how and when it actually occurred. There's also some really interesting history actually on the Reserve Bank of Australia's website. They've actually got a document that goes through the history of different bank challenged events over the last couple of hundred years and the different ways that they were either propped up or kept afloat or not kept afloat, what worked, what didn't work. Just to give you a little bit of an insight that, hey, banks do actually have challenges. And we actually had a run on a bank, although it wasn't a bank at the time. So St. George was actually a building society back in the day. There was a radio broadcast that said that the bank was in trouble, or the credit society was in trouble, and that caused a run on the bank. So a run on the bank is where people go and want to withdraw their money straight away. That caused a run on the bank, which actually put the bank in a lot of jeopardy. Now, it wasn't beforehand in trouble, but because of the fear and people starting to take the money out, it actually got to the point where the bank was actually challenged. And so the government at the time had to say, well, we'll guarantee those deposits are actually safe. And that stopped the run on the bank, and that kept the bank afloat. So, there's been a number of different ways that things have happened over time to try and both bail in and bail out, and a number of other ways to protect the banks. And some did work and some didn't. Reason why I'm mentioning it is because bail in is getting a lot more momentum ever since the GFC. And in the GFC, you may remember that Cyprus Bank actually did a bail-in. So in Greece, Cyprus Bank actually did a bail-in and caused a heck of a lot of pain for the people of Greece at the time. But ever since then, it actually has become a global agenda item. And here I am sitting here in Brisbane, and back in October 2014, Brisbane had the G20 summit. And bail-in was actually an agenda item for the global top 20 countries in the world to actually discuss bail-in and how that might actually work. So this is an extract out of the actual document that I don't know if you call it a prospectus, but this is the agenda items that were actually for them to discuss. So the conversation piece was, well, basically the GFC was caused by the fact that they thought that some banks were too big to fail, being the Lehman Brothers and a couple of others, but they actually did fail. And so what they're saying is, well, rather than governments propping it up, we should actually look at a bail-in tool as a key component with the appropriate powers in place for dealing with these financial failing situations, okay? They then go on to say that the bailing in of creditors when a financial institution is placed into resolution provides an alternative to a bailout using taxpayer funds and to liquidate under the ordinary insolvency procedures. So this is the G20 on a global level saying we should actually start to look at these bail-in laws as becoming a mandatory part of what we actually do as a global economy. Because what happens is one country, and in that instance, it happened to be the USA, if their banks start to fail, then because they're interconnected to every other of the major economies out there, then it causes a cascading effect, which is what happened in the GFC. And so what they're saying is, well, we all kind of need to work in unison to actually protect the system, okay? So that's why it actually came into effect. Now, let's have a look at some of the repercussions of that. So there were two financial services reform bills that came into effect on the 4th of February 2017 that were actually, 2018, I should say, that were actually written up prior. So the Crisis Powers Bill is what they called one of them. So it's actually got a much longer name. So the Financial Sector Legislation Amendment Bill of 2017. So the intention of that was to strengthen APRA's powers in times of financial crisis. There was a secondary bill that came in at the same time called the ADI Bill. So the Treasury Laws Amendment, Banking Measures Number 1 Bill of 2017. Okay, so the intention of there was to enable the financial stability to enable credit card reform. Those two bills together, when they came into effect, there was a lot of conjecture as to whether or not they were actually trying to actually implement bail-in by stealth. Now, I actually spent the last 2 days trying to read the legislation, and I'm not a lawyer by any way, shape, or means. So I'm going to defer to someone who is a lawyer and take some extracts out of them. Now, I'm cognizant of the fact that whilst they are a lawyer, they happen to have an agenda, which means that they believe it is bail-in, and so that's why they're reporting it this particular way. So I'm not saying that they're right. What I'm reporting to you is their point of view, okay? So what I'm saying here is that there is conjecture there largely because of the language used within the documentation. I've actually read a great deal of the documentation. So they're referencing words such as an instrument and a recapitalization direction. Now, an instrument there, they're loosely saying is, well, we can come up with something that we're going to direct you to do. And that something could be the recapitalization direction, which is arguably the actual bail-in event. Now, here's an extract, and I've got the link below for you to actually have a look at. Mindful of me declaring that this is conspiracy theory territory. So this is an extract out of the page where you can see from the citizensparty.org, and it's a legal opinion allegedly by a solicitor. So the issue that they're talking about here is the definition of a financial instrument, okay? So what they've looked at is to say, well, the deposits are actually deemed to be an instrument under the APRA regulation, okay? Which means that can they actually grab your money as your deposits before at any point in time? Well, plausibly. So plausibly. But in order to do that, they would have to be either change their internal bylaws to actually enable that, or be mandated by the regulator, being APRA, to say do that first. Now, remember, APRA are the ones who legislate to say whether or not the financial guarantee comes in. So if the FCS deposit guarantee were to come in, that would only be because the bank has failed. Whereas a bail-in is an attempt to stop it from failing, which means that the bail-in could technically could be enacted before the guarantee actually comes into play. Now, it's a loose thread, but I certainly see that it's actually plausible. If we go into a little bit more detail, so the legal opinion is by a gentleman by the name of Robert Butler. So this is an extract out of his document, and there's a link to the entire document down the bottom. So basically what it's saying is that there's actually a provision within the bank's terms and conditions that actually allows them to vary the rules pretty much at very short notice, okay? So, and most of the banks have actually gone through, and he's gone to the effort of actually looking at the conditions of each of the banks, and specifically the deposit terms and conditions of each bank. And he's pulled those apart and basically given an interpretation to say, well, they're basically saying that we're giving the ability for APRA to come in, and if APRA dictates, then we can technically trigger a bail-in, okay? So this is all assuming if, and I say if, APRA as the prudential regulator issue that command. Now, so it all swings on, I guess, the intention of APRA, and nobody is really clear on that. Certainly when challenged publicly, what their verbiage says, it is not the intention of the act. Now, whilst the word is intention, so it's not the intention, but they don't rule out the fact that the power is there. So it's not the intention, but can it be enacted? Who's to know, okay? So let's have a look at some of the terms and conditions in each of these banks. And now, I understand that for many of you trying to read this on very small screens, it's going to be quite tricky. So I'll do my best to give you the gist of it as we go. So Commonwealth Bank has a little under the table kind of clause that says, we may give you a shorter notice. So they normally say 30 days notice to make any changes to their rules and regulations. Under the table, they say, we may be able to give you a shorter period or no notice of an unfavorable change if we believe doing so for us is to avoid, reduce, or materially increase our credit risk or our loss. So effectively, they say, if we're in trouble, we reserve the right to change the rules at any point in time. Really interesting that they can say that they can actually do that. And it's written in plain language right in front of everyone. The NAB is a little bit more surreptitious, that basically says that the NAB will make any changes in accordance with any applicable legislation and industry codes, which is them saying, well, we're not going to write it into our T's and C's, but if APRA says that we have to, then that's what we'll do, okay? Interesting that they kind of declare it like that. Westpac, we can only, so again, they're 30 days. We can also give you a shorter notice period or no notice if we believe that it is necessary to avoid or to reduce a material increase in our credit risk or our loss. So they're all basically saying, if we think that we're going under, we can change the rules without notice. And each one of them pretty much say the same thing, okay? And I can go through them one by one, but they all pretty much say the same thing, basically saying, we believe that we're going to do everything that we can under normal terms and conditions when everything's going well. But if things don't go well, we reserve the right to change the rules without notice. And we can be commanded by APRA as to what those changes in rules can be. So that's really, that adds to the, I guess, the conspiracy theory to say, well, the banks have actually started to enact the fact that it is actually humanly possible to actually do this. What is really interesting is when I looked at the legislation itself was this particular clause, which is a secrecy provision. So APRA may determine that any of these directions is actually governed by a secrecy provision. And if you breach that secrecy provision, that's imprisonment for 2 years, which means that if APRA wanted to be underhanded and if APRA wanted to keep it a secret, they could actually slip it in under the covers without anybody actually knowing that it was actually there. Now, I'm not usually a conspiracy theorist kind of guy, but when I start to look at these things, I go, there's enough plausibility here to say maybe it's in place. But again, I'm not, I'm not legal enough to determine whether or not that actually is there. But I said before, there's conjecture as to whether or not it's there or not. So where that conjecture gets a little bit murky is that the IMF, the International Monetary Fund, actually issued a report in February 21 of 2019, which is only about 14 months ago. And when we take an extract out of that particular report, and here's two paragraphs out of it. So paragraph number 53, they're actually saying that more needs to be done to ensure the authorities are well positioned to resolve systematic important banks to address the systematic banking crisis in the form of contractual bail-in instruments. So the IMF are saying to Australia, you need to implement bail-in, okay? Really interesting that they're kind of saying, you need to do it, folks. And then it goes on further on the very next clause to say, well, not only do you need to do that, but you need to have a deposit insurance scheme, which we do, and a statutory bail-in scheme based on best international practice. So what they're trying to say here is, folks, we're trying to tell you that as a world economy, you guys need to play ball. So the question is, in February 2019, are IMF saying that because they don't believe that the current legislation implemented in 2018 is actually strong enough? Or are they just kind of putting it on record saying, hey, you need to do it, and the Australian government going, it's okay, folks, we've already got it in hand? I really don't know where I sit on that one. And so unlike Chicken Little, I don't think that the sky is falling. I'm saying here that I want to be alert but not alarmed to say there needs to be a little bit more homework put into this, and maybe a number of people can go talk to their local federal representative or things like that to go, let's get a little bit more info on this. If you believe the conspiracy theorists, and I say if you believe them, that means that bail-in would actually come into effect prior to the deposit guarantee, which means that the ability to take your funds away could actually be done without notice, and it could be done secretly without notice. If you don't believe the conspiracy theory, then at best your funds are not secured unless and until APRA actually trigger that. And so in triggering that, you need to put some best practices in place with regards to how and where your funds are actually distributed. So my guidance to you folks is, in summary, is to make sure that you don't put any additional surplus funds into a redraw facility, okay? Instead, make sure that you put that into a separate deposit account, which has a mortgage offset capability, which means you effectively don't pay the interest on that portion of the loan, but it is separate in and so therefore it is actually protected under the FCS. Make sure that you have no more than $250,000 within one ADI or one family of banks owned under the one ADI. So make sure that that's the case. If you do those two things, then if the conspiracy theory is false and the FCS is actually enacted if a bank fails, then in that case you should actually be protected to the best of your ability. If not, and if the conspiracy theory is in place, then nothing you can do can actually get to it because it all happens prior. That said, do I believe in the conspiracy theory? I'm going to say no, but there's enough plausible credibility there to say I'm going to be certainly asking enough questions of the relevant people to see if I can get a little bit of an answer. I'm going to do a little bit more homework on this myself. What I would say, though, is that the ability for banks to change the rules without notice when they're in financial trouble, in itself, not a good practice. The fact that we don't get any notification on that, not a good practice. The fact that APRA can change the rules with a secrecy clause, not a good practice. So there's a few things in there that I'm not real comfortable with, but having said that, I'm alert but not alarmed is probably the way I'm going to phrase that, to say I'm certainly going to make sure that I'm going to be implementing best practices, and I'm going to encourage you guys to do so as well. So that's kind of the end of that little one, folks. What I'm going to suggest to everyone is make sure, like myself, that you are educating yourself as we're coming into these troubling times. You need to be educating yourself on what the market is actually doing. You need to also be educating yourself on what your investment strategy is. And I say that because I think there are opportunities abound coming. And now is the time to be learning, folks. Now is the time to start to put the effort in. We're locked up. We've got time to ourselves. We can see that there's going to be a dip in the market, but all of the fundamentals for the property market, at least, are pointing in an upwards trajectory. Our economy is pointing down, but the property fundamentals are up. And if we get this kickstart from the federal stimulus packages, I think that that we will start to recover. Property is then going to go well, so it's going to go down and then up. Is it going to go down and up fast? I don't know. Is it, there's conjecture. Is it going to be a V shape? Is it going to be a W shape? Is it going to be an L shape? There's a few different economists predicting a whole bunch of stuff, and that's well beyond my pay scale. But what I can say is I think that there will be a down period and then a recovery period that makes sense to prepare for and makes sense to say, well, there's going to be opportunities that present itself on the other side. As Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. And right now, I'm thinking that the market, people are going to start to get fearful, and that is the time for us to start to get greedy. And I'm not saying in an overly capitalistic way, but to say, opportunity, folks, prepare yourself to know how to recognize it and how to benefit from it. Now, for many of you, that's going to mean you need to learn some alternate funding methods. So banks at the moment are tightening up all of their lending. So you need to start to learn about not only how am I going to invest, but how are there actually different ways of actually doing alternate funding of projects, and specifically how to do no money down deals. And there are going to be no money down deals aplenty coming in the next, I'm going to say, 3 to 12 months. There's going to be plenty of no money down deal opportunities that are going to present itself in abundance over and above any other period in our lifetime. So what I would encourage you guys to do is join our virtual meetups. These Facebook Lives happen every single Sunday, but we also have a monthly event for Brisbane, Sydney, and Melbourne that we used to run in a very physical capacity. Now we're running them as virtual events right now. So I always do an industry update at these events. We also have industry experts talking about different issues and challenges, etc., to actually help you on your development journey. We also have people within our community sharing real deals. So make sure that you certainly come along to these. And we also have a masterminding session that are going to help you to actually progress forward on your journey. Okay, so we have the community actually help you out in these sessions. Now, in order to come to these events, whilst we're in this virtual world, I guess we've had to try and limit this to only our annual members. So if you're wanting to be an annual member, we normally have our annual membership for $250. But right now we've got $99 in order to join. We're trying to get as many people as we can using these virtual events. And in 2 months' time, when we're projected to be doing face-to-face meetings, you'll be able to come to the face-to-face meetings for the rest of the year. Okay, so 12 months worth of membership for $99, normally $250. If you would like to know about how to do that, SMS the word annual to 0438 090 833, and we'll get you some information on that. Or alternatively, I'll do a paste as to the link that you can actually jump on as well. So that said, folks, I'm going to go and see if I can get some questions from our community, see what we're see who's got some questions as to what's been happening here. So let's have a look, folks, and see who's got a question or two. Give me a sec while I jump on what people are saying. I can't see. I can only see one person saying hello. What's happening there? I can see 47 people actually watching, which is fantastic that that's happening. Just give me 2 secs while I. Whoops. Oh. Okay. Sorry, folks. Just technology challenges because I use Zoom in one space and I use Facebook in another, so it can get a little bit challenging as to seeing questions. But I can see a whole bunch of you in there. Wow, there's a lot of people saying hello. So I'm not going to go naming you all, but hello, all the way down, and see if I can find a question. So Luke's got the very first question. Luke says, will the lenders need to extend their mortgage deferral period, if not forced sales to come? Interesting. Need to extend their mortgage deferral period. So plausibly, mate. So there's a 6-month moratorium on loans at the moment to say if you can't fund your loans because you've got tenants that aren't paying, or they've lost their jobs, that sort of thing. So you can defer your interest for 6 months. I'm going to say likely they won't extend that further, and that's because they're screaming up and down at the moment to say how broke they're becoming because of this, because they're I guess not generating any revenue, and they're deferring that over a very long period of time. So they're crying poor at the moment. So I'm going to say likely they won't, mate. So, but watch this space. More people saying hi. Luke says, what happens to small business? I'm going to say there's a number of small businesses that are going to come back to life instantly, mate. There's a lot of things that I guess people have been operating and just having to change the way they do business. So some businesses are going to, were nimble and able to pivot quite nicely. Other businesses are going to struggle. So if you're in the restaurant business, the hospitality side of things, those guys are limited to the number of people they can actually have inside their shop. And that limit is is creating a glass ceiling at the moment to say, well, yeah, I can have people in there, but it's not financially viable for me to have only 10 people in my coffee shop. It's not even worth me opening the doors. Just the cost of the overheads of actually opening up just don't make that make sense. So there's going to be some businesses in that boat that might have to wait for, I guess, round 2 of us being released to see how that goes. Now, see if I can grab some questions. Luke's got plenty of questions, so I'm going to see what else others have got. So Peter says, infrastructure takes too long, probably by cash injection. No, mate, I'm going to say infrastructure does take long, but it generates jobs, okay? And then jobs in themselves generate more jobs. So rather than just throwing cash at it and then it just going into a dead end, infrastructure projects kind of have this massive flow-on effect. So if you think one person employed has some cash, that person now has some money, they can go to a number of other businesses and spend that. Now that business has some money, they can then go to a number of other businesses and spend that. So it kind of flows on, what they call trickle-down economics. So it's much more efficient for infrastructure projects that generate jobs to actually get people back into the workforce, mate. So I think that's more likely. Luke's got a lot of stuff, mate. I'm gonna loop back around to you, mate, because I just want to grab a few other people's thoughts first. And thank you, Luke, for putting the link in for the approved list of deposit-taking institutions. So I appreciate that. Now, Luke's saying he loves my controversial. Thank you, mate. I appreciate that. Sam says, there's not too much you can do to protect yourself. The IMF wrote in 2013 that a surprise one-off capital levy would be a good way to restore public finances. The appeal is that such a tax, if it is implemented before avoidance, is possible, and there is a belief that there will never be repeated, does not distort behaviour and may, yeah, okay, mate, that is so long, I don't even know what the question is, other than to say IMF said, IMF have made a number of suggestions that the global economy are actually starting to implement, mate. So I'll actually have a look at that IMF document that you've put in there. So thank you, I appreciate that. So like in Cyprus, the government could decide to take your money out. So yeah, so I think effectively they're really saying bail-in is the first approach, and then bail-out is the second approach. But before bail-out, which impacts taxpayers, they prefer to put the deposit guarantee in place. So that's the IMF's approach. That was certainly the G20 approach as well. And my conjecture is I think it's possibly actually in place right now. Peter says, Rob, should we need a glass of red? Mate, I'm going to say I'm definitely going to need a glass of something at the end of this. I went down so many rabbit holes in trying to do this investigation for you folks. So it has certainly earned me a drink or two, I can assure you. Sam says, State Bank of South Australia was early 1990, not regulated by RBA at the time, roughly 3 billion loss to South Australian taxpayers. Pyramid Building Society in Victoria. Yeah, mate, there was a number of banks that actually struggled over a number of different years. That I encourage you to actually do the Reserve Bank of Australia search. They've actually got a document that actually goes through and looks at all of the failed institutions over the last 200 years, how and why they failed, and what were the things that were attempted to and did they work. And so it was really a really interesting thesis to say, you know, when we study what has actually happened in real world, what do we think is actually plausible? So yeah, so Luke says, really interesting stories, a lot to come in the next 6 months. Absolutely. Ray says, should we ask public question on this from APRA and possibly publish this? Mate, I think that all of us should actually do a direct question to APRA, not on behalf of Property Developer Network, but on behalf of yourself as a citizen to actually ask the question. Now, the official party line is it's not the intention. Now, not the intention does not mean that it is not possible. So I think it's very clear that we need to be, we need to actually word our questions very specifically, that we say, we understand it's not the intention, but does the power exist? Okay, or is it possible? Something along those lines might get a very, very different question. Okay, a couple of people saying that they're doing PMs between each other, no problem at all. Rachel says, we're being encouraged to hold cash rather than invest in a volatile market. Plus we need to hold cash ready for our next development. So how safe is our cash? Right this very second, Rachel, I'm going to say your cash is safe. Right this very second. We are not yet in a recession. We do not yet have any banks that are in financial trouble. So right now your money is safe. This is really, once we start down that slippery slope, and depending upon how far we go, then what happens? That's the point of today's chat. So it's not meant to say, get your money out. It's not meant to say the sky is falling. It's just meant to say, if you are alert but not alarmed, and if you're prepared to know what may actually happen, then as we start to get into situations where banks might start to get a little bit dicey, then we know what to do to actually protect ourselves, okay? So please don't make any rash decisions right now. This is really just about understanding, to the best of my research ability, where I think the legislation actually sits, and what some of the others out in the community are actually saying is plausibly possible. When I say plausibly possible. Jane says, hi, Rob. Even though this group is for property developers, I'm finding the content very interesting for a newish investor. Thank you, Jane. Appreciate that. I guess we are property developers, but we're also property investors. I encourage our guys to be investing very much in property market, but do that in a wholesale way, not a retail way. That is, by doing the development, we're actually manufacturing the profits, and we manufacture those properties to keep at a wholesale rate, not a retail rate. So we're not buying the finished product off somebody else. We're manufacturing that ourselves. So hopefully that gives you some insights, Jane, and welcome to our community. Okay, a lot of people talking to each other. So Sam says, if you're talking about greater than 250,000, the lower risk cash would be on your own government. Oh, he's replying to Rachel, sorry. So that's fine. And a lot of people talking between each other, so I'm just going to ignore those. Noel says, thank you for the extremely interesting research. You're welcome, mate. Again, more people talking to each other. Subo saying, hi, Rob. Will the government fast track student and skill migration with quarantine? I'm going to say no. That's a pure just guess. No, they won't be fast tracking that. They'll be concentrating on keeping jobs within Australia. They won't be trying to import jobs for others. I think they really, really genuinely are going to be trying to protect the local economy as much as humanly possible. That's just conjecture, mate, but no, I don't think that's going to happen. At 0.25%, so that's another one going back and forth. Angus says, thanks, Rob, very informative. You mentioned that you see that there will be a lot of opportunities for no money down deals. Can you explain a little more why you think there will be more opportunities for this and why people will be more open to this? That is probably one of the best questions that I've seen in here, Angus, so thank you very much for that, mate. The logic behind it is pretty simple. There's a lot of people that have owned property for a very long period of time. Maybe they've owned it for 20 plus years. That is effectively their retirement fund. Now, the baby boomers in particular, they're approaching retirement right now at a time where the economy has just tanked. And so they will be looking for any opportunity they can to maximize their cash return, which means that they will give you terms in order to give you access to the property to do the development process in order to achieve the price point that they want. Remember, if they've owned it for, say, 20 years, time's not that critical an element to them. And so, you know, if they wait a year for their funds or wait 2 years for their funds, but they get a much higher price point than they would selling it in the current market where the market is recessed, then that's where it's really going to become very beneficial, mate. And remember, I think that, I guess COVID has triggered this and kind of gone counter-cyclical, but the property market, I think, is actually pointing in an upwards trajectory. All of the indicators are that supply and demand, there's plenty of demand because we've got a massive population growth with 10 million people over the next 25 years predicted within Australia. So there's lots of population growth anticipated. Right now, because of what's happening, the number of development approvals going through, very, very low. The number of construction actually happening, very, very low. So the demand is going up and up and up, but the supply is not actually meeting it. So there's going to be this competitive tension that basically says, once we get on the other side of this, I think that the property market's going to kick. And I think it's going to kick relatively well. And so if you can negotiate terms with somebody and say, look, I can get you that price, but I need these terms in order to actually achieve that. That's how I think it's going to be possible. And in this market, plenty of that, mate, because lots of people are really looking at their only chance to cash in and the timing of that. So great question, Angus. Thank you, mate. Rachel says, thanks, Rob, for an excellent plezo. Yet again, you're very welcome. Luke says, good research, super informative. It's the reason people keep coming back to watch. Thank you, mate. Really appreciate that. he also asks, how much do you know about the bank's liquidity and risk of major default? At this moment in time, Luke, I know nothing about their liquidity or their, I guess, how close they are to default. I'm going to, I guess, not try and speculate on that at this point in time. I know that APRA, as the regulator, have a constant eye on that, and we would start to hear both in APRA public records and also the media when we start to hear banks actually in trouble. So at this moment in time, I don't see anything on the radar, but I'm just talking worst case scenario. If we're coming into recession, then a bank is a business, okay? And so businesses can fail when everything's falling around them. Luke says, awesome info, Rob. I've had technical issues, but I can't see what the I is, but glad you're enjoying it anyway, Luke, so thank you. And number of more people talking in between each other. So folks, looks like that's the end of the questions. Hope you guys have got plenty out of that. Our next virtual meetup, if you are an annual member, is next Saturday. So please, 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 if you are very interested in joining us, getting the lowdown on what's actually happening in the market in a lot more detail, and also getting to hang around with your peers, progress your property journey and the like, then please join our virtual meetups. I will stick a link into the chat window in a sec as to how to actually do that. So looking forward to seeing you all on the next meetup, folks. Luke throwing in just the very last bit of conspiracy right at the very end, and he says, I thought you said APRA had the secret clause. So yeah, mate, you could be right. Maybe the banks are in trouble and APRA says got to keep it quiet, but I really seriously doubt that. But yes, I'm going to leave that one at that point in time, folks. I think that is a great one to end on. So thank you all, and we shall see you at our next virtual meetup and at our next Sunday session. Bye for now, folks.